Hey, what's up, everybody? It is Thursday, August 26th. I'm really upset about the terrible news out of Afghanistan. 12 more of our soldiers killed in this disastrous war affair, whatever you want to call it. 20 years in, got to get out. Been trying to get out. More lives lost, not to mention the Afghan lives lost. It just is tearing me up, man. It's so bad. I mean, to see our people die and their people. These wars, and it is not an official war. I mean, this was just, again, we went in there to take out Al-Qaeda. We took them out very early on in the first couple of years, and we stayed on as a military operation, which it never should have been. But anyway, I'm not going to get into it. It's just, the whole thing really, really upsets me. It really, really upsets me. Those were 12 of our people who were alive yesterday, and they're gone now. Not to mention, the other innocents who were slaughtered. I mean, it's a terrible, terrible situation. Anyway, today is my last day in LA. For those of you who are wondering why I'm in LA, I'm visiting my daughter. She moved out here in May. She is a young and very talented filmmaker, and she wants to break into the film industry. She's won some awards for her films that she has shot and produced. And it's very exciting, very exciting. So I came out here to visit her, and I'll be back in New York tomorrow. Today we went hiking a little bit, had a great time. Anyway, let's talk about the markets. The main thing I want to mention here is I just looked at, and I apologize for the time delay. Usually I get these videos out, just shortly after the market close in New York time, but it's a 3-hour difference here, and I've been running around. But anyway, I want to talk about the weekly Fed release, the H41. And once again, reserve balances hit a new record high. That's 8 weeks in a row for an increase of $692 billion. They're printing money. That is real. That's real money printing. 692 billion in the last 8 weeks, reserves at 4.203 trillion. And I mean, it's pretty astonishing that bond yields are not significantly lower, but they are lower than where, if you go back 8 weeks when this reserve build began, we've had about a 200 basis points rally in the 10-year Treasury note futures. But you got to understand one thing. Fed repos also at a record of 1.4 trillion. So, the Fed's been pulling that cash out as fast as it can. I mean, think about it. Without those repos, reverse repos, I should say, reserve balances would be over 5 trillion. What are we now? 4.2 plus 1.4, 5.6, almost 5.7, almost 6 trillion. I mean, it's incredible, man. So if the Fed was not doing that, like pulling out that cash, I mean, we'd probably be at negative bond yields right now. But look, this is not a permanent solution. As I've said so many times, this is like a ridiculous. What's going on is ridiculous. I mean, the Fed is part of the problem, pumping in $120 billion a month in reserves. The banks are struggling. Like, it's also incredible, I have to say, that we're actually seeing any loan increase at all, which we are in the weekly reports and the weekly bank statements. It just shows you how strongly capitalized the banks are, because even with this unprecedented reserve asset burden, they're still able to increase loans, which is incredible. It shows you how well capitalized the banks are. And again, I think the banking sector as an investment, those stocks, the big banks, I mean, they're like the cheapest and most attractive securities in the whole entire market. And just the fundamentals, I mean, if the banks are so well capitalized that in spite of this massive, massive, massive reserve situation that they have to deal with, they're still able to increase loans. I mean, that's an incredible thing. That's an amazing thing. It shows you how strong they are. And I think, again, the taper, and it's going to start, if it starts in October, November, it's really like insignificant. I mean, what I want to say here is the initial taper is going to be very modest. It's going to be very small. Now, of course, you're going to get the zombie reaction. You're going to get people, oh my God, they're taking away the punch bowl and this is it and blah, blah, blah. And they're stepping on the brakes and all this BS, but it's not going to be enough. It's not going to be enough because you still have what's coming is additionally a significant amount of reserve build, even with Treasury right now under the debt ceiling constraint, because I think there's something like another 350 billion left of these so-called extraordinary measures that Yellen can use to make the payments. Now, I said once the debt ceiling comes off, and I'm going to go on record, I think that they are going to figure out a way to raise the debt ceiling. It's not in the reconciliation bill, which is weird, because how are they going to do it? I don't know. But anyway, I think they're going to do it. And once they do it, I think that clears the way for a major, major new credit cycle. And the credit cycles, that is what really is like throwing gasoline on the fire. I mean, the fiscal support that we have had, that's fantastic. And that has helped avert probably an economic depression with the COVID and everything else like that. People have used those funds, those government transfers. A lot of people have used those government transfers to pay down debt and stuff like that. We've seen that, early on anyway in loan contraction and stuff like that. The only way you could have loan contraction is that debt has to be eliminated. But if you have a new credit cycle here, man, that's going to be something. So I just see good times ahead. Now, having said that, we had a big pullback in the market. And again, I think there's two things going on here with respect to that. Number one, this terrible, terrible news out of Afghanistan. Maybe that was the catalyst, the trigger for it. And number two, I sent out today to my subscribers a breakdown of sentiment from the AAII Weekly Sentiment Survey. You need to see that. And I told my subscribers this morning early on, we got a bearish signal. We got a bearish signal. I told them that. So they were updated on that. Hopefully some of them, went short on the market or got some downside protection. But that's temporary. The fundamentals are still there. It's still supportive. We still have the fiscal support, and we're going to enter into a new credit cycle. I do believe, I have to go on record, and you could hold me to this, but I don't know. I just don't think, as bad as they are in Washington, I just don't think they're going to, let things default. I think they're going to come up with a way to raise or suspend the debt ceiling for a period of time. They have to. Come on. I mean, they have to. So, yeah. We get a pullback here. Let's build up some more bearish sentiment. But, the other day I said we're going to see new highs. We're still going to see new highs. We're going to see 36,000 on the Dow and above. We saw new highs the day after I said we were going to see new highs in the NASDAQ. We got that. So, this is okay. This is totally understandable. But again, New record in reserve balances, 4.2 trillion, and Fed doing 1.4 trillion in reverse repos, like, taking that money out just to keep the banks functioning. And I'll repeat, it's pretty amazing how the banks, under these conditions that we have, which again are unprecedented, they're able to still make loans. Like, they're all under these regulatory constraints. And all of you who have been, kind of brainwashed into thinking that the banks lend out the deposits. No, I mean, this is proof. I mean, the rate of lending has slowed down. I mean, it's picking up a little bit now from where it was, but I mean, all of these massive deposits, this reserve addition is handcuffing the banks. But even with these handcuffs on, they are so well capitalized, they're still making loans. It's impressive. I think it's impressive. And when you take the handcuffs off, what do you think is going to happen? Boom. Big, big, big new credit cycle begins. So get ready. And if you think housing prices are high now, like, if builders don't start building, if we don't get, and I'll come back to, I'll say this again because I've said it so many times. If we don't get to a level of like 2 million plus for at least a year in annual housing starts, I mean, prices are still going to go up. If you're waiting to buy something because you think prices are going to go down, forget about it. You need 2 million plus at least for a year, maybe 18 months, maybe 2 years before you get enough inventory to bring prices down. Hate to tell you that. All right, that's it for today. Don't forget to go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. I'm the only one who has an applied approach to MMT.